Welcome back to Fiscal Voyage. I'm Felix. In today's video, we're going to talk about a recent buy that I did after an earning report. This stock dropped significantly, over 20% for the day, and I bought more shares. And I'll show you why I bought shares. So first off, the stock that I bought is GPC, General Parts Company, 14 shares at around 120. So it's actually lower now. I think it's like 113. And about $1,700 worth for the 14 shares. So right now it's at 113.70, and I'll tell you why I bought more shares of this company. So right now I'm total down around 17% in the position, but I will be buying more shares at 105, and I'll show you why shortly. But first off, you can see here the earnings has changed. So we go back to forecasting here. The previous 3 months or 6 months, it was kind of the 6 months ago they had around 990 for General Motors for the year to make $9.90 in earnings, and then 3 months prior to earnings it was $9.39, and then currently is $8.12. So they had a pretty bad Q3 earnings report, and Q2 and Q3, and we're gonna show you what happened and why I bought shares and why I'm gonna buy more shares. So first off, currently it's still undervalued. You can see here, even if they report earnings of $8.12, if it were to revert back to 15 PE, you have a return around 55% from around 113 to 121, and 55%, or if you were to hold to the next few years, around 12% annual rate of return. And if we go here to historical and shorten this to 9 years, you can see here, if the company were to revert back to a normal multiple around 19, you can have a 24% annual rate of return, even with this down year that they're expecting, a negative 13% down year from 2023, from 933 to 812. But they're expecting back to growth in 2025 and 2026, 4% in 2025 and 8% in 2026. And analyst scorecard is pretty accurate. You can see here it hits 75% of the time in the 1 year period, and around 83% of the time in the 2 year period. So I'm pretty confident in this. And if you look at other estimates that I'll show you soon, they're all kind of saying the same thing as well. So for example, if we go to Morningstar, the Morningstar now updated the report and give it a 4-star buy rating. You can see here with the fair price at 132, and you can see here they have it undervalued here at the 113 area. And some of the things I like, well, first off, in the industry, a lot of the other companies, the competitors, they all are overvalued. You can see here AutoZone is overvalued, O'Reilly Automotive is overvalued, and WW Grinder is also overvalued. And some things that I like to see here when I look at estimates is revenue is still expected to grow. Price to sell is low based on 2022, and I'll show you that shortly as well in fast graph. Net margin is more or less in line with previous years, so nothing worried there. It's slightly lower, but not too major. And if we go to fast graph, you can see here in sales, sales expected to be up 3% in 2024, and then 4% in 2025, another 4% in 2026. So if you weren't looking at just price to sell ratio, you can see here around 0809 when it had around a 0.5, 0.4. Right now we have a 0.6, and it looks like 0.5 more or less is the area of great support to buy when the stock has a price to sell of 0.5, and that should coincide with the technical, and I'll show you why shortly, because I look to buy more shares around the $100, $105 range if it gets down there, and it looks like it's gonna get there, but we'll see. But you can see here it is undervalued because normally price to sell tends to be around the 0.7, 0.8, and you can see here we're around under 0.7 and way below 0.8 in price to sales, and as well as earnings before interest, tax, and depreciation and amortization. You can see here they're expected, down year this year as well, but a nice increase in 2025 and 2026, a double-digit increase. And you can see here it tends to normally be around the 10, and we're here way below that, under 8 price to earnings before interest, taxes, and depreciation and amortization. So that's things that I like here. And we go to forecasting, back to forecasting, and I like to use the normal multiple here, and I look for the shortest one, the smallest number, so that even if it were to go back to 19 or 20 multiple, that's okay. Am I satisfied with a 17.8 multiple? And you can see here we could get a 21% annual rate of return for the next few years if we were to revert back to that multiple, which is great. Even if it doesn't, if it stays around, let's say, the 14 multiple, is almost 10% annual rate of return on a solid company. And speaking of solid, this company is BBB credit rating with a dividend growth history. And you can see here it continues to grow its dividend. The recent increase in 2023 was 6%, and if I think they announced another increase this year, 5% in February. You can see here they boost dividends by 5%, so they continue to increase the dividends around the 5 to 6% ratio in growth in dividends. So other things I like here, if we go to the price to sell, the Morningstar here, you can see here price to sell, like we mentioned earlier, it is below the 0.7. But the 5-year average is around the 0.9, so that's a good indicator that's undervalued. Price to earnings here, you can see here the current based on the 5-year average is undervalued as well as the price to cash flow undervalued as well, and price to book undervalued as well. So a lot of things that I like here. PEG ratio is good, under 1.5 compared to the 5-year average, so that's why I bought more shares. Interest coverage looks good at 18, and the debt to equity is decent at 1.28. All this looks good. That's why I bought shares, and I'll show you why technically. First off, let's go to CFRA. They have a hold currently because they haven't updated the price here. You can see here at 143, but the price target at 125. But they have a fair value price of 156, so it's kind of where I think the fair value price is, at 140, 156, with a 3-year projected earnings of 5%. And you can see here they are expecting earnings to increase in 2025. And if we go to Yahoo as well, analysts are expecting the next 5 years 7% increase in earnings. So that's all good indicators. That's just basically a down quarter that affect the price tremendously, and it's going to be a down year which affects the price, which is okay, for a long-term investor like myself. I like to buy shares when it's when it has a crash like that, because a lot of times the market extend itself in crashes, and it gives opportunity for long-term investors to buy shares. And here's another example here. Currently the average price target is around 133, and the current price is at 113, so there's good opportunities to buy shares. And now if we go to the technical, this is why I bought shares. You can see here this was resistance, now became support. So I'm expecting support, and it comes right into this moving average, the 3-month moving average on the 50, and you can see here it's pretty decent on when the stock bounces. Now, like for example, it went under it, but still, would you been happy if you bought this company at $35? I hear $23, even though it went further down to $18 over here at $35, and it went down to $25. Yeah, you would have suffered maybe for a few months, but then look what happened, right? It's kind of the same deal. So if it gets to the $100 area here, 106, 107, I will be buying more shares of this company because it has room to kind of hit this moving average at 106, between 106 and 102. And that $100 area is always strong resistance, strong support area. So we'll look for that. Right now I'm just gonna hold the current position I have. Like I said, I'm down around 17%, but I'm gonna buy more shares if it gets to the 106, 107. And if it breaks this support area, this is gonna be definitely my next buying opportunity here, because if it breaks this 105 and maybe heads to $100 and break $100, that 90, the 185 area is going to be the strong support. And why I say that is because it's moving average. This moving average, the 200 moving average on the monthly, has tremendous support. You can see here, this is in 2000, the dot-com crash, strong support here. This is in 2008, 2009, strong support here. You can see here, much better buying opportunity than the 3 months. And strong support here on the COVID. This was a flash crash right here. You know, you buy it right here at $60. Sure, it went down to $50, but in a week or two, you were back positive and loving life because you bought shares of a great company at a great price. So if it does, you know, I will be buying more around this 105, 107 area. Now, if it, you know, fumbles around here and then gives us a crash here to $90 to 90 to 85, I will be buying more because this will be the next area of support, and I'm gonna be buying more shares. I don't have this position as a full size position. Currently own about 40 or 50 shares. I would like to double that, so I'm gonna be doubling it. Not doubling it at 105, but I'm gonna be, you know, buying another 14, 20 shares worth here around 105, 106, and then wait and see if it gets to this $90 area, $90 to $85 area, because of this 200 monthly moving average. Now, you know, why not just wait for that? Because of this, again, this could bounce right here. It looks kind of extended, and we have this huge gap here, so it may want to hit to 107 and then trying to fill the gap. So I'm going to look to use that as an opportunity to buy shares at that 105, 107 area, 110 area. So we'll see what happens. So that's why I like General Parts Company. Back to the fast graph, you know, as again, this company has been very solid. If we look at operating cash flow, covers the dividend, so the dividend is well covered. Free cash flow to cover the dividend, you know, they expect it to be fairly covered in 2025. But you know, while you wait, you're getting a 3.5% dividend yield, with a company growing it at, you know, 5 to 6% annually, like clockwork. And you can see, and even during 08, 09, the company still continued to grow its dividend very nicely, and just hasn't stopped since, and it has plenty of room to continue to grow that dividend. So that's why I bought more shares. Again, if we go back to my interactive broker, 14 shares around 120. Again, if we go back here, I am planning to buy more shares around the 105, 107 area because of the monthly 3-month moving average, as well as the strong support area here. So that's why I'm looking to buy more shares. And you see here, it looks like it's gonna, once it breaks this 112 area, if it breaks that, it could get to 110, 107, and that's why I'll be buying more shares. And if it doesn't, you know, if it bounces from here, I'm okay with it. I bought shares up here, and I think my average is around maybe 130 or so, which is okay. I would just wait and see what happens. But if it does get back down, I will be buying more shares. Thank you for watching. Make sure to hit that subscribe button if you want to see more videos like this, and I'll see you guys in the next one. Take care.